Morning, everyone. Welcome to today's research morning call. So on Saturday, we had our Singapore 2Q22 strategy and stock picks, and this will be a summary. So first of all, I'll pass on the time to Paul.
Okay, thanks, Vivian. So we will be providing a summary of our second quarter equity strategy that we did on Saturday. The title of our report for second quarter strategy was a stagflation shelter. So what we're basically saying is that we're entering into a stagflationary environment, which is a high inflation and slower growth or stagnating growth. That's why you call it stagflation. But we think Singapore stands out in this current environment, which we will share later. Next slide. Next slide. Okay, so in terms of rising interest rates, so in this environment of higher inflation, which also implies an interest rate cycle, which we think there'll be at least another 2 percentage points of increase in the Fed funds rate, which will impact Singapore too, we'll show later. In terms of the beneficiaries of a rising interest rates, you have your banks and even stock exchange, which is almost 50% of the STI. Stock exchange, maybe some may not be that familiar, but a typical stock exchange like SGX, they collect collateral deposits from derivative clearing members. So this is as much as 12-13 billion. So if you do the maths, if you assume a 1% increase in the float in interest rates, they could collect almost 130 million. But of course, they have to share. They could share some of it, but you can see the impact of higher interest rates for even the stock exchanges, and this is like pure profit because you don't have to do anything extra. The other beneficiary is retail, which is also a reopening. The next is telco, which is also benefiting from reopening. Conglomerates, not so much reopening, but it's more a restructuring, re-rating story, where you have higher dividends and higher share buybacks. Transport is also reopening, which includes your air and land transport. Hospitality is obviously the reopening of borders. And defense, we think, is also another re-rating story as post-Ukraine-Russia conflict, there'll be an increase or a surge in military spending globally. Next slide. So in terms of the impact, so although US rates might be rising, so the next question is, will Singapore interest rates rise too? So if you look at this chart, it shows the SIBOR, which is the Singapore interest rates. Of course, there's also SOR and SORA, but they more or less move in line directionally. And then there's the Fed funds rate. So when the Fed funds rate rise, right now it's 0.25, and we think the expectations it could rise to almost 2.5. It could meet the high which we saw in 2019. So when that improves, that will also benefit the banks. Benefit the banks in two ways. So the banks have a float, they collect a lot of CASA and a lot of the money they cannot lend out. So we estimate roughly, some of it in Sing dollars, some US dollars, almost 160 billion. So this is parked with other banks, this is lent to other banks or parked with the central bank. So any improvement in rates will benefit them, because it will just drop down to profit directly. The second way is through higher interest rates. When rates rise, they can charge more to their clients. But of course, their cost of funds doesn't move so much because Singapore banks, one thing unique, they hold a lot of CASA, which is virtually zero interest rates. I mean, looking at your savings account, obviously they're not going to raise interest rates for us. So that's why there's two ways how the banks benefit. And there's like a 90% correlation. When the rate line rises, the Singapore interest rates will also rise. Next slide. So the other thing that will benefit for us for Singapore is, of course, interest rate cycle. The domestic economy will also benefit because of the reopening of borders. And tourism is a big part of the economy. Although it's only 5%, but it's 5 percentage points, and as a matured economy, 5% is a lot. So for us, we could get roughly about 4 percentage points of growth just from reopening of borders. No, not everything will occur overnight, especially China accounts for 20% of tourist arrivals in 2019. And that won't happen until maybe who knows, maybe hopefully next year. But again, at least we have this tailwind for the domestic economy. Next slide. The other benefit is, of course, there's an improvement in employment, especially when the borders reopen and economic and activities recover. You can see that the improvement in jobs, this is the quarterly change in jobs. So that only happened in the fourth quarter, and you can see the amount of job losses that we've had. So we're not fully recovered, but you could see job improvements coming back on in 2022. So right now there's like 2 vacancies. So there's two vacancies for every 1 person looking for a job, which is like unemployed. Next slide. So next, I'll just move on to the sector trends. I hand it over to Glenn for the banking sector.
Thanks, Paul. So for the banking sector, we will just look at the fourth quarter 2021 review. There's broad-based growth despite lower NIMs. Fee income grew while NIM remained stable, and GP write-backs made the difference in the fourth quarter. So for the first line, the net interest margins, or NIMs, remained stable quarter on quarter, but it was down year on year due to lower market interest rates. However, the net interest income, or NII, in the second column, it grew 5% year on year, mainly due to loan growth of about 9% year on year, with stable NIM guidance for 2022, full year 2022. The loan growth guidance of mid to high single digit remains for 2022 as well. So the third column, we can see the net fees and commissions continue to grow at about 8% year on year, driven by wealth management fees as investment and trade activities pick up. So for the PATMI, it grew by 24% across the board, as you can see from the fourth row here. However, this was put down by OCBC's decline in PATMI of about 14%. And this was mainly due to higher SPs, which I will go into more detail later in the OCBC slide. So credit cost continues to moderate across the board, with full year 22 provision guidance for banks lowered. DBS at 12 basis points and OCBC and UOB at 20 to 25 basis points. Lastly, the CET1 ratio of 13.5 to 15.5% is above the operating range of 12.5 to 13.5%, prompting active management of capital. Now, moving on to the next slide, we look at the outlook. So the outlook, the 2022 outlook, we maintain overweight and remain positive on the banks. The bank dividend yields are attractive with upside surprise due to excess capital ratios, and improving economic conditions as well as rising interest rates remain tailwinds for the banking sector. So you can see from the chart here, we expect a gradual NIM recovery, with majority coming in only after the second half of 2022. There's also room to recover to the pre-pandemic NIM levels of about 1.7 to 1.8%. So there's quite a large space for the NIMs to recover to. So regarding the interest rate hikes, I think Paul touched upon it earlier, but based on the guidance that the banks have provided, 100 basis points increase in the rates would mean about an increase of 18% in PATMI for the banks. Also, lastly, I'd like to touch upon the Russia-Ukraine conflict. And I'd like to highlight that all the banks, the local banks, have reported minimal to no exposure to Russia, and they are complying with all the sanctions. So that's all for the banking sector. I'll now hand it over to Terence.
Hey, thanks, Glenn. Yeah, for the conglomerates that we cover, the transformation remain well on track. For Keppel Corp and Sembcorp Marine, on the table on your left-hand side, even though we are naturally concerned about the delay in the decision-making time, the second delay in their decision, we know that the delay is only 1 month. So the 1 month, as we understand from them, is really to tie up some of the loose ends, due diligence, and finalize the consideration ratios that they'll be distributing to shareholders. So we think that kind of alleviates the worry over this 1 month delay. Just to recap, the key terms of the 2 MOUs that Keppel has signed, under the first MOU, Keppel will receive shares in the combined entity should the merger take place, that it intends to distribute to all its shareholders. Under the first MOU, Keppel is also set to receive a cash consideration of $500 million. Under the second MOU that Keppel has signed, its O&M legacy REITs and associated receivables will also be sold to a separate asset co that will be formed. Keppel will retain not more than 20% stake in the asset co, and this minority stake is expected to be monetized over time. For Sembcorp Industries, its 2025 target remains on track. In 2020, to recap, they actually set a target of 70% of their net profit to come from sustainable solutions. In 2020, that's actually 40%. And even though you see in 2021, the sustainable solutions profit actually came down to 35%, there is not an indication that their efforts have slowed. Rather, the reason why the renewable or sustainable solutions is lower versus 2020 is because the conventional energy actually grew at a faster clip than the sustainable solutions. That's why it came down. But even though it came down, the renewable energy segment still grew at a very fast clip. For first half of 2022, they expect to hit 6.1 gigawatts of installed capacity. That's all for the conglomerates. In our next slide, on the construction sector, the construction sector continues to see a strong recovery in 2021. 2021, the overall construction demand came in at $30 billion versus 2020's $21 billion. For 2022, this year to 2025, they have actually revised the overall construction demand upwards. They tightened the range from $25 to $32 billion previously to $27 to $32 billion. I think what is noteworthy also is that if you look at the guidance for construction demand, they actually provided a longer term guidance versus the 1 year, 2 year guidance that they provide previously. They actually provide a 3-year guidance of 27 to 32 billion. This, in our view, we think really signals the BCA's confidence and target of achieving this construction demand going forward, and also provide support for the construction sector. On the table below, if you look at the wages for higher skilled and lower skilled workers, you can see that the wages are still about 40% higher than pre-COVID levels. This, we think, is the impetus to continue to relax border restrictions for foreign workers to return in Singapore. If you look at the chart on the right-hand side, you can see that for January 22, for December 2021, the number of foreign workers actually started to recover, and that is the result of them relaxing border restrictions, especially in the fourth quarter of 2021. We expect this to continue we expect the authorities to continue to relax border restrictions in 2022. So that's all for me for the construction industry. I will hand over the time to Natalie.
Thank you, Terence. Now I'll be talking about the Singapore property market. So the December cooling measures proved effective. The residential price index increased at a slower 0.4% year-on-year compared to 5% increase in the previous quarter. Landed sales grew 4% quarter-on-quarter, while non-landed private residential prices in the CCR and RCR fell by 0.5% and 3% respectively, with the OCR being the only one showing a 1.9% quarter-on-quarter increase. Although this is slower than 4Q 2021's 5.7% growth. So the developers moved 1,700 units in the first 3 months of 2020, and this is 50% lower than the same period last year. And this was partly due to the light launch pipeline of 1,000 units compared to 3,000 units in the same period last year. And meanwhile, the resale transactions were about 37% lower year-on-year. We lower our FY22 home sale forecast from 10 to 12,000 units to 8 to 10,000 units, while keeping our expectation for the private home sale prices to rise by 0 to 5% unchanged. We think the sales volume could remain soft in the next quarter as buyers mull over the cooling measures. The reopening of borders would allow more prospective overseas buyers to conduct physical viewings, and that might result in higher foreign buying. Overall, the developers are still trading at an attractive 40% below RNAVs. Now moving on to the REIT sector. So this chart demonstrates the inverse relationship between the yield curve and the light blue, the yield curve in the light blue line, as well as the FTSE REIT index in dark blue. The shaded periods are when the yield curve was declining and the spread between the 10 and 2-year treasury bonds were narrowing. And we saw that the REITs rallied. The yield curve started flattening in the second half of 2021, as seen on the far right-hand side of the chart. And we could potentially see REITs rally, supported by the recovery of retail, office, and hospitality REITs as the world returns to normalcy. The rising interest rates is intended to keep inflation and growth in check, and this may result in a reversal of flows back into stable stocks like REITs and growth stocks. This might result in a reversal of flow back into stable stocks like REITs, as growth stocks look less attractive on a risk-adjusted basis. We remain overweight on S-REITs due to the high level of interest rate hedging employed, which averages 72%, as well as portfolio rebalancing and rejuvenation efforts by the REITs during the pandemic years. REITs made 13 billion in acquisitions in 2021, entering this phase of recovery with even stronger balance sheets. Now moving on to the retail subsector. Retail occupancy hit a 10-year low in 2020, but has since rebounded to 92%, and we're starting to see rents bottom out. Reversion for suburban malls have started to turn positive, while negative reversions for downtown malls are narrowing. And there is also very little new supply hitting the market. Singapore announced further relaxation of COVID-19 restrictions on the 28th of March. Some of the measures include the raising of dine-in and group sizes from 5 to 10, resumption of atrium sales, higher capacity limits for events, the higher of 1,000 or 75% of venue capacity, as well as return to office or the workplace capacity has been increased from 50% to 70%. So this return to office, as well as a pickup in social activities, should help lift tenant sales and return confidence back to retailers. We are overweight on the sector, especially for suburban malls, which despite their resilience during the pandemic, are still trading 15% below pandemic levels. And now moving on to the office subsector. Okay, so in this graph, we try to illustrate the relationship between the growth of office rents, GDP, and inflation. GDP growth is a leading indicator for office rents, as positive growth implies that businesses are doing well and expanding, leading to more demand for office space. In 2018, GDP growth slowed, and similarly, so did the growth in office rents. So office rents started recovering in 2021, and according to CBRE, CBD rents have posted 3 consecutive quarters of rental growth, although this is still 6% below the recent peak in 2019. The office sector experienced a flight to quality during the pandemic, which allowed REITs to backfill most of their vacancies. However, occupancy at 88% is still 2 percentage points below the 5-year average. Technology and ICT companies and banking and finance companies accounted for more than 50% of leasing demand. And as occupancy improves, we expect rents to move to the upside. Yeah. Despite this, we are neutral on the office sector as supply is slightly elevated. The 3-year average supply of 1 million square feet per annum is above the 5 and 10-year averages. With return to office, and while return to office should allow occupiers to better evaluate their space needs and result in more decisive renewal discussions, we are cautious that more downsizing could occur. Okay. Now moving on to the industrial subsector. So rents have bottomed out after declining for 7 years, and we also saw an uptick in occupancy back to 2016 levels, largely due to better occupancy at factories and warehouses, and partially offset by business parks, which saw some downsizing by office-using tenants. Industrial REITs benefit from the secular growth of new economy tenants such as tech, life science, biomedical, semicon, and electronics manufacturing. We are also seeing structural shifts such as e-commerce and manufacturers moving from just-in-time inventory management to just-in-case in view of supply chain disruptions. These tenants typically locate themselves in high specs, science and business parks, as well as warehouses. Industrials have taken a backseat in the recent months as the recovery theme was in focus. We think that it is a good opportunity to pick up industrials which have been resilient during the pandemic and benefit from structural demand. And due to early share price recovery, industrials were the most active on the acquisition front in 2021, increasing their exposure to new economy assets. And based on consensus forecasts, industrials are expected to deliver between 3 to 10% FY22 DPU growth on the back of AEIs and acquisitions. So we are overweight on this sector. Now moving on to the hospitality subsector. So in the dark blue line, we see that RevPAR has improved, and this is on the back of higher occupancy as well as average daily room rates. And although improved, the RevPAR is still 41% below pre-pandemic levels. February 2022's occupancy was 62%, and this compares to 45% a year ago, while the ADRs climbed by 27% year on year. In terms of international visitor arrival, IVA for short, Feb IVA was 4.6% of pre-pandemic levels, meaning that there's still a long way to go before Singapore's IVA actually reaches back to anywhere close to what we were doing pre-COVID. Quarantine-free entry into Singapore for vaccinated travels will begin on the 1st of April 2022, and the removal of quarantine as well as VTL designated flight requirements and reduction of COVID testing requirements is a big step towards rebooting Singapore's tourism industry. However, we expect the number of hotels booked by the government for isolation purposes, which has benefited some of the hospitality REITs, to taper off. Overall, the hospitality sector still faces a long road to recovery, and we think recovery to pre-pandemic levels will likely occur in 2024, and in line with STB as well as World Tourism Organization's forecast. And we are neutral on this sector. So that's all for me. I'll now hand the time back to Paul.
Thanks, Natalie. I'll move on to electronics, focus on just the semiconductor side, industry. So on the chart that you see here is basically the typical cycle, the up cycle for semiconductor. I'm looking at just global semiconductor sales. The typical up cycle can be the 1.5 years to maybe two years. Right now, the current cycle up to January at least is already almost 2 years. But we think it could probably extend up to early 2023. The three reasons why we think so. Firstly, due to the shortages and disruptions in the supply chain, you're beginning to see the industry buyers starting to have inventory buffers. So in the past, you could get semiconductor supply quite easily, and you could run your production seamlessly just in time. You could just get delivery within 1 or 2 days. But right now, because of all the disruption and also higher prices, a lot of the manufacturers now need inventory buffers in view of all these disruptions. That's the first reason. The second reason is also the consolidation the last couple of years, even before the recent pickup. As a result, there's been fewer suppliers and capacity has been lower, and utilization was already high before the recent pickup. As a result, new wafer fabs and foundries had to be built, and that require at least another 18 to 24 months, and that will elongate the cycle. The third reason is also, we've probably seen all over in the news, US, China, all want semiconductor production in their own countries. And as a result of this, you're going to see additional capacity coming up. And all these three factors are actually prolonging the cycle. Of course, the worry for us will be 2023. The first worry is because of all the same reasons. You have an inventory buffer because prices are rising. And what happens if prices come down? Then you get the reverse. People need to destock. The second reason is, of course, you think there could be overcapacity because of strategic reasons. So I think, and also as the reopening happens globally, consumers are not spending less on goods and notebooks and computers. They'll be spending more on services. So the worry will be more on 2023 when all these positives will actually work in reverse for the semiconductor sector. Sorry. Next slide. So this is the unusual chart that we just put in. So this is the ARC Innovation ETF. Because electronics or tech is so wide, but we wanted to just highlight that in terms of unprofitable tech or profitless tech, the valuations have probably peaked in early 2021 or late 2020. For us, this is important because a lot of the specs listed here will be injecting a lot of technology companies. So we just have to be mindful that the whole valuation hype and so forth has already peaked, and just have to be a bit more mindful in terms of the D-spec or the technology companies that these specs will be acquiring. Next slide. In terms of telcos are another beneficiary of roaming. If you just look at StarHub's earnings, if you assume 15% of mobile revenue is roaming revenue. So roaming, just as a refresh, is when your StarHub customers go to Malaysia, for instance, then StarHub also earns revenue from them. And secondly, likewise, if a Malaysian comes into Singapore and taps on StarHub's network, then StarHub will also earn revenue. And this is pure profit. It doesn't cost StarHub anything. They're not going to have another one salesperson talking to this client. It's virtually automatic, and the profit will just drop to the bottom line because there is no additional cost. And also because of the way the pandemic right now, mobile data roaming becomes more essential, because if you land into Malaysia, for instance, you definitely need to have your so-called trace together equivalent. So the roaming will become even more elastic or even more necessary. So if you look at this chart again, if you take 15% of roaming is profit, then almost half of StarHub's profit in FY19, which is pre-pandemic, actually comes from roaming. PAT is profit after tax. Next slide. So my next slide is just on medical. Healthcare, we're a bit more cautious. Firstly, you can see here the admission numbers have dropped quite significantly. And secondly, there will be also less COVID-19 related revenue from vaccinations, from testings and so forth. So this will be a more of a year of consolidation for the private hospitals especially, which we think we're referring to just Raffles Medical. Just as a side note, if you look at this chart, if you look at the red line between 2010 to maybe 2014, you can see that hospitals have done really well, the admissions. They were outperforming the blue line, and the valuations, and they had high growth, and the valuations were at extreme levels. But since then, if you look at maybe 2018, 2019 onwards, you can see that public hospitals are growing faster, and that's because of the new public hospitals being built. And that's the other worry, that the growth rate for private hospitals may not replicate the good old days of 2010 to 2014. Where their growth was, can be as high as 10, admissions could be high as 10+%. Next slide. Next slide. So we move on to the stock picks. We just run through our model portfolio of 10 stocks. So in this model portfolio, we try to balance it with yield, with dividends and earnings growth, and also re-rating plays. So in first quarter 22, what did well for us was the large caps like Keppel and Comfort and City Development, and even Comfort. But what performed badly was our mid-cap names such as Asian Pay TV, Del Monte, and even HRNet. We took out Q&M. We still like Q&M. We have a buy, but it's mainly because near term they won't be having the COVID-19 earnings, so we think earnings will be just moving sideways. Next slide. So this is just an illustration of performance. The chart on the left since 2018. Again, this is purely illustration. It doesn't include brokerage. Of course, it doesn't include the dividends that's collected on a portfolio, and it also doesn't include monthly rebalancing. So because we have a 10 percentage point allocation to each stock, because you have 10 stocks, right? So each is 10. So we actually assume there's a rebalancing every month end. So we don't take into account that transaction cost. So if you look at the performance on the right, we underperform the STI by 4 percentage points. Basically, in a nutshell, the banks just steamrolled us because banks is 50% of the index. So there was no way, I don't think neither us or many funds can have like 50% of their index on just banks, apart from the ETFs. Okay, next slide. Okay, with that, I think I'll hand over to Glenn to discuss about the banks.
Okay, thanks, Paul. So I will just touch upon DBS for a bit. So the DBS, the one main point I'd like to bring up regarding their fourth quarter results would be that their total allowances were significantly lower year on year, but higher quarter on quarter due to a lower write-back in their general provisions. So their specific provisions fell 82% year on year to 67 million or 6 basis points, but this remained relatively unchanged quarter on quarter. So as I mentioned earlier, their full year allowances fell by 98% year on year to 52 million due to repayments of weaker exposure, credit upgrades, and transfers to non-performing assets, resulting in general allowance write-backs during the year. So full year credit cost of 12 basis points is below their pre-pandemic levels. Management has guided for similar allowances for full year 22. Moving on to the outlook, with DBS's capital position and liquidity, the CET1 ratio of 14.4% in fourth quarter 2021 versus 13.9% in fourth quarter 2020, well above regulatory requirements and high allowance reserves, we believe that DBS has sufficient provisions to ride out current economic uncertainties. Even if we were to include the acquisition of Citigroup's Taiwan consumer banking business, as well as MAS's operational risk penalty, the CET1 ratio of 13.3% is still at the upper end of DBS's target operating range. And their fourth quarter 2021 DPS dividends per share is up 9% to 36 cents, above pre-pandemic levels. So for upside from higher rates, DBS has mentioned that a 1 basis points rise in interest rates could raise their net interest income by 18 to 20 million. This will represent a net income sensitivity of 2% for every 10 basis points rate hike. If we were to assume 2 rate hikes of 50 basis points this year, our full year 22 NII can climb 2 billion or 21%, resulting in an increase in our full year 22 PATMI by 26%. It's also a benign provisioning cycle, and DBS has guided credit costs of 12 basis points. This is below the pre-pandemic levels, with FY18 at credit costs at 19 basis points and 2019 credit cost level at 20 basis points. This lower credit cost is mainly due to lower SPs as well as an improving environment. As such, we maintain and accumulate with an unchanged target price of $41.60. Now moving on to OCBC. OCBC, the main point I'd like to bring up would be that their SPs increased 109% quarter on quarter. So SPs of 387 million were made during the quarter, and this is 109% higher than the third quarter's SPs of 185 million. This increase was mainly driven by project financing delays due to supply chain disruption brought about by COVID. Management has also said that they are located mainly in Greater China and do not pose a systemic risk. However, despite this, OCBC was able to write back GPs of 70 million during the quarter, and this was mainly due to downgrade of accounts to their ECL Stage 3 allowances and the refresh of their macroeconomic variables in their ECL model. Total NPAs rose by 2% quarter on quarter and 8% year on year to 4.3 billion, but their group NPL ratio was stable at 1.5%. OCBC has also guided for credit costs of 20 to 25 basis points for full year 22, compared with 2021's credit cost of 29 basis points. So for the outlook, for the loan growth, loans grew 8% year on year in fourth quarter 2021, and this is meeting the bank's guidance of high single-digit increase for full year 2021. Management sees further lending opportunities in the wholesale segment as well as sustainable financing. The green and sustainable finance segment was up 66% year on year to 23.3 billion and now forms 8% of its loan book. The mortgage pipelines in Singapore and Hong Kong are also healthy, with more drawdowns expected in full year 2022. So for their NIMs, management has guided for stable NIMs of 1.5 to 1.55% for 2022. Nonetheless, it said that based on historical data, a 100 basis points increase in rates would lead to an 18 basis points increase in NIMs. If we were to assume rate hikes totaling 100 basis points this year, based on our calculations, our 2022 NII can climb 725 million or 11%, resulting in an increase in our full year 22 PATMI by 10%. So OCBC is our preferred pick amongst the 3 banks due to attractive valuations, upside in dividends from the 15% CET1 buffer, which is the highest amongst the 3 local banks, and lower provisioning as the Indonesia and Malaysian economies recover. We maintain a buy with an unchanged target price of $14.22. That's all I have for the banks. I'll now move on to Terence.
Yeah, thanks, Glenn. For Capital Corp, with the chapter on SPH now closed, we see the re-rating catalyst from the potential divestment of its O&M business, Asset Co, and the logistics business. And we see the rebound in the oil and gas capex spending as a impetus for the potential divestment of its O&M business to Sam Marine. You can see in this chart here, the O&M spending actually plunged in 2015 as a result of lower oil prices. But this has started to pick up and is poised to also pick up in 2022 as oil prices go higher and also firmer. So we continue to watch closely its potential divestment of the O&M business and Asset Co, but we keep our buy rating on Keppel with a target price of $7.07. In our next slide on BRC Asia, BRC Asia for us is a key proxy to the construction recovery. BRC Asia is a market leader with 2/3 of market share in the industry, about 66 to 67% market share in the steel reinforcement industry. The BRC Asia's growth is supported by the strong construction demand forecasted by BCA in 2022 to 2025 of 27 to 32 billion. Its valuations of 8 times financial year 22 PE is also undemanding versus its 15 times historical average, and it also has a good dividend payout of 8.1% of FY22 dividend yield. So we keep our buy on BRC Asia with a target price of $1.84. That's all from me. I'll now hand over the time to Natalie.
Hello, thank you, Terence. Now I'll be talking about Ascott Residence Trust. So for Ascott, just looking at the graph on the right-hand side, we see that occupancy has actually improved tremendously from 30% to 60%. And throughout the whole pandemic, ART actually remained operationally profitable, meaning that they were profitable on a gross profit level. And as reopening kicks in, as the borders reopen, we think that the corporate and leisure demand will return, and travelers may take longer, more purposeful trips, and this might benefit service residences which have larger rooms as well as kitchenettes, making it a more comfortable stay for slightly longer stay periods compared to hotels. In terms of the gross profit breakdown, we see that there's actually stable income as well as growth income. So the stable income comes from master leases as well as MCMGI, which is management contract with minimum guaranteed income. That means there's a floor to the income. This provides some stability for the portfolio, as well as some of this increasing portion of extended stay assets, which currently forms about 17% of AUM. There's also the growth income, which is the one that is dependent on occupancy as well as room rates. So as recovery picks up, we expect this growth income to also increase. Secondly, of course, the second reason why we like Ascott is because of this growing segment of extended stay assets. They have recently raised their target allocation to extended stay assets from 15 to 20%. To 25 to 30%, implying more inorganic growth to come. And initially, they have grown this segment from 5% to 17% since 2020. And this extended stay assets include student accommodation as well as rental housing, which have average lengths of stay of from 1 to 2 years and high occupancy above 95% even during the pandemic. So of course, this provides some stability for the portfolio. Yeah. So now I'll move on to the next counter, which is FCT. So for Fraser Centrepoint Trust, 64% of GRI is actually derived from tenants in essential services sector, which comprises F&B, supermarkets, pharmacies, and services such as clinics and hair salons. So as you can see in the graph, FCT's tenant sales in red outperformed its peers during the pandemic, and it clearly demonstrates the relevance and resilience of suburban malls. In 17 out of 22 months of the pandemic, tenant sales were between -6% and +6% of 2019 levels. While FCT also experienced negative reversion during the pandemic, negative reversions were in the low single digits compared to the negative double digits experienced by downtown peers. Portfolio occupancy has also already recovered to pre-pandemic levels since the second half of 2021. And FCT has signed some new leases with positive reversions. And despite this, FCT is still trading at 15% below pandemic valuations, which is why we think its resilience has been underappreciated by the market. And we have a buy call on FCT with a target price of $2.64. Next slide, please. So for CDL Hospitality, for CDL, so we see two main reasons why CDL could potentially benefit. First of all, it will be the recovery of its operations, the recovery of the hotel segment, which in 2020, as you can see in the boxed up bar, it posted a 202 million EBITDA loss. And in 2021, that has since swung to positive territory. And as the borders reopen, we should expect this hotel segment to continue to recover. CDL also has 3,000 units in private residential inventory for them to sell and allow them to capture the peak of the property cycle. So in terms of strategic kind of opportunities that we see for CDL, first of all will be the redevelopments. CDL has already announced the redevelopment of Fuji Xerox as well as Central Mall. And these two assets are actually located, near the central region, and they benefit from GFA uplift because they qualify for some of the schemes that the URA has. Yeah. Another asset that also qualifies for redevelopment under the CBD incentive scheme is City Tower. Although there has been no formal plans for this asset as of yet, if CDL does go ahead with this redevelopment, then they could potentially also reap some GFA uplift and create more units of residential units to sell. The last part for CDL is the monetization of their assets. So CDL has 3 assets in the UK, 3 UK offices that they plan to monetize by injecting into a REIT. And not to mention, they also are intending to monetize some of their hotel assets. In December 2021, there is they announced distribution in specie as part of their dividends, and that effectively will help them to deconsolidate CDLHT. And it also indicates to us that they intend to be a more active sponsor, and these divestments will then allow CDL to possibly capture some portfolio gains, if they are able to sell above book value. Okay, so with that, we have our buy rating on CDL with a target price of $9.19. And I'll now pass the time over to Vivian.
Thanks, Natalie. So the first counter I'll be covering is LHN, which is a real estate management services group, and they are riding on the hottest property trends. So firstly, we have on the left co-living under the Colliu brand, and also work plus store outlets, which are under industrial properties that have been facing surge in demand as a result of the e-commerce boom. So firstly, for Colliu, the co-living spaces, they have been facing high demand even throughout the pandemic, mainly due to the prolonged work from home trend. So while the Singapore borders were closed, demand surged from young working professionals who were seeking their own living and working spaces. And with the borders reopening, and construction activity recovering, they are seeing demand from those who have finally waited for renovation activities to start and are waiting to be completed. For co-living, it also proved to be a better option as compared to renting maybe a condominium or HDB room, or even staying in a hotel, as you get the privacy and everything you need in the room. So some of the rooms in some of their locations, as shown in the picture, are fully furnished with kitchenettes, washing machines, but they also have communal spaces where tenants could mingle with other residents. So you get the best of both worlds here. And on the rents, they have also been on the rise in line with inflation, which would cover the higher energy costs. This is also seen in the trend for the local private residential property rental index, which has risen to its highest in 7 years. And not to mention, with the full reopening of borders, they are expecting additional demand from foreigners, both expats and international students. So for FY22, we are expecting about 200 keys to be added to the Colliu portfolio, and this represents a 25% year-on-year increase. So moving on to work plus store outlets, which has been facing high demand from online business owners for spaces. So with 70% of the work plus store spaces occupied by e-commerce tenants, if you were to start an online business and you need a space to maybe store your goods or do some working, WPS would probably be the cheapest option for you. And as can be seen from the chart on the right, on a rolling average basis, the value of online sales continues to remain elevated throughout the pandemic until now, as proportion of online sales remains high. And similarly, rentals have also risen by about 10 to 15% for renewals and new tenants. Something to differentiate work plus store from other competitors or industrial properties would be that they offer value-adding services like last mile delivery services to deliver the goods to your customers, car sharing services, and also EV charging facilities. For FY22, we are expecting the addition of another 500 units, which implies an increase of about 30%. Valuations wise, it remains attractive at 5 times price to earnings with ROE at about 19%. So we have a buy rating with a target price of 49 cents, and our valuations is derived from 7 times FY22 PE. So we are not ascribing huge valuations to the listing of the logistics business yet, which could provide further upside. Moving on to Del Monte Pacific, the turnaround for the US subsidiary or Del Monte Foods is still underway, as can be seen from the chart. So the losses that they incurred from FY18 to FY20 was mainly due to the onboarding of the new management team, which tried to turn the whole business around. They transformed the whole business by closing the loss-making factories, as a result, incurring the huge amounts of one-off expenses. But as we can see from the successful turnaround, this is due to the focus on the higher margin branded retail business and also de-emphasis of low margin non-branded channels. For FY22, we are expecting net profit to possibly triple to above $40 million. And on a 9-month basis, the net profit is already more than double that of FY21. For Del Monte, there are strong market leader positions in US and also the Philippines and other international markets like China, provides an inflation hedge against rising raw material and energy costs. So they increased prices by about 10% in 2Q of FY22. And there are further price increases implemented in 4Q. So we are expecting margins for 4Q to recover from 3Q. And the reason for continued market share growth despite the higher prices is that more consumers are turning to trusted brands like Del Monte for better quality meal preparation options. So for Del Monte Philippines, we expect continued stable growth with dominant market shares in certain segments. As for the international sales, this would be mainly on the fresh fruits business. So fresh pineapple sales are expected to rise with expansion into tier 2 and 3 cities in China. An additional catalyst would be the refinancing of the most expensive $500 million debt at which was taken at 11.875%, possibly at lower rates of about 6%, which could lower finance costs by about $30 million or 30% in total due to the refinancing. And also we are expecting better cash flow, mainly due to higher profits. So the valuations remain attractive at 8 times price to earnings, while peers are trading at an average of about 20 times. And forecasted dividend yield for FY22 is at 6.2%. So we have a buy rating with a target price of 63 cents. And I'll now be passing the time on to Paul.
Okay, so thanks, Vivian. So the other stock that we like that has kind of underperformed, and hopefully nobody knows about this, is ComfortDelGro. So ComfortDelGro, just as a refresh, is the largest taxi operator in Singapore and even regionally, and also they operate buses and they operate trains. So a few reasons why we like it. So firstly, it will be the reopening. So if you look at the taxi business, so last year, Comfort made about 150 plus million, but that is after having to give almost 80 million of rebates to taxi drivers. So the rebates is basically, the discounts on the taxi rentals. So that will be the first driver when the rebates start to recover and they give less rebates. And number two is the taxi is also doing a bit better in this environment because of hybrid taxis. So they're more competitive than the private hires. And secondly, taxis usually enjoy much cheaper fuel than the private hire vehicles. So that's number two. Number three is also if you look at this chart, whenever there's a reopening stock, we're always mindful whether is there any camouflage. What we are trying to say is that because it's a reopening play, we should just buy it. But we also wary whether because of the pandemic, has the balance sheet been hurt? Has the competitiveness been hurt? So for ComfortDelGro, this did not happen. And you can see that during the 2 pandemic years of 2020-21, they actually managed to generate 900 million of free cash flow. So in fact, during the pandemic, the balance sheet actually was better. So that's the third reason. And number 4 is basically the whole the valuations. And also we expect reopening to benefit their Australian and UK businesses, and also the train business. And all this is and this is a very high leverage, operating leverage business. What we mean is that when revenue climbs, So when an additional passenger rides on the train, there is no cost for them. So everything goes to profit. So that's why we like it because of the high operating leverage. Next slide. So this is the last slide in terms of our stock pick. So the next one is HRNet Group. So HRNet is one of the largest recruitment agencies in Asia outside of Japan. There's two parts. There's flexible, that means temp hires, and then there's permanent, like the usual headhunters that you see. So what makes this unique is that, firstly, you can see from the title, out of their market cap, 40% of it is net cash. I think 300 million is huge for a mid-cap company. So 40% of it is cash. They're trading cheap, 11 times PE, and if you really want to strip out the cash, I think then this drops down to low single-digit kind of valuations. They are paying a 5% yield, and with the net cash, they can continue paying this year for a couple, or even higher the next few years. And of course, they got a 30% ROA. It's a very asset-light. So the ROE is almost more than 50% because there's virtually no assets. The fixed assets is only, I think, 1 to 2 million. The rest of it is just working capital. So that's the one. The first thing is the attractive metrics. The second thing is the whole recovery in jobs. So you can see that we showed you job vacancies are at record highs. As a result of this, number one, demand is strong. And number two, because it's difficult to find workers, a lot of corporates will want to work closer with recruitment agencies so that they can find the better, so that they can find the staff that they need. The third reason is that because of the shortage of workers, there's also increased salary. And if you're placing out a permanent hire, you usually get 2 to 3 months, of the person's salary. And because of the higher wages, you get higher prices. And the fourth reason is because of this chart. So HRNet is not only in Singapore. So Singapore is roughly maybe 60% of profits. So the rest counts on rest of Asia, which they are slowly beginning to grow. 2020 was a down year because of the pandemic, but they have offices in China, Taiwan, Malaysia, and also Indonesia. So they only started growing rest of Asia more meaningfully in 2018 with some organic and inorganic acquisitions. Inorganic means they acquired some recruitment agencies, and inorganic means they send their own staff to all these countries to do a startup. And because they have strong links to their corporates, be it headquarters in Singapore or Shanghai, they've been able to do placement, recruit, get these mandates, even though they might be an Indonesian mandate and so forth. So these are the 4 reasons why we like it, and we have a target price 118 at a buy call. Next slide. Just to conclude it, the current macro backdrop is stagflationary. That means high inflation and stagnating growth or slower growth. But we think Singapore benefits because of the interest rate cycle, and domestic economy will benefit from the whole reopening. The sectors we favor is financial, construction, telco services, and transport. And our STI target revised up from 3.4 to 3.7. So with that, next slide, I think we can, this is our analyst, we can move on to the Q&A. You can just turn to the next slide. Next slide is just some of the Stocks BNB is where we get our reports. This is a telegram where we will inform you of reports and also inform you of some of the listed company webinars or any events that is being hosted or conducted by us. And the one on the right is just our podcast that we do. Okay, with that, I think we can move on to Q&A. Thanks.
I think I'll just take the few banking questions first. So the first one is that, is there a concern that the share price of Singapore banks have been dropping since despite come dividend, in particular DBS dropped more than the dividend given out, and that institutions have been net sellers of the banks for the past few weeks? Okay, so I think the main concern is that why there is a sort of like the price has been dropping is because of the inversion, the yield inversion, sorry, a bit of background noise. Because the banks have been sorry, let me get my thoughts. Yeah, so there is a sort of impending, they are assuming that a recession is approaching and the inflation is going up. So with that, of course, it will affect the banks. But overall, I would think that the banks are still quite okay due to the increasing interest rates, as well as their growth has been, for their loan growth has been quite stable, and they're guiding for similar growth in 2022. So I don't think it's that much of a concern. Next one, iFast. Sorry, we don't cover iFast, but based on their recent results, their AUA has been continuing to register new record levels. I think it's 19 billion now as of 31st December 2021. And their growth is also quite sort of meeting their targets. And they are now just moving forward to try to execute their 4-year plan, which is to sort of accelerate their Hong Kong business as well as to add their digital banking capabilities to their ecosystem. And they also want to build this truly global business model. But I can't comment particularly on the what price and target and everything. So there's one more question. Okay, so why is UOB not in your top 10 picks? You had OCBC instead. Okay, that's a good question. I think I mentioned earlier when I was talking about OCBC, why OCBC is our preferred pick. It's mainly due to two things. So there is upside in dividend from their 15% CET1 buffer, and this is the highest among the 3 local banks. As everyone knows, DBS and UOB have both acquired Citibank's assets, and DBS also had that MES operational risk penalty. So their CET1 has been notched down, but OCBC still hasn't. So there is an upside to the dividends, and we might expect higher dividends. And secondly is the provisioning. So the main negative for their recent results would be their SPs were extremely high, 109% increase from the previous quarter, whereas the other 2 banks have not sort of reported increased SPs. So this, they say, is mainly from China and due to their project financing delays. But there's also increase in NPLs in Malaysia and Indonesia. So with the expectation that the Malaysian and Indonesian economies will start to recover, this will be notched down for OCBC, and that would sort of bump them up. So that's the reason why we chose OCBC. I think that's all for the banks. Paul, if you have anything to add on to why the top 10 picks, that would be great. Thanks.
Sorry, add on to what? Sorry, I missed it.
Why the UOB is not in the top 10 stock picks.
Okay, yeah.
You want to add
I guess in part the share price has also done pretty well. For UOB, I guess UOB's CASA isn't as good as the rest. So if you're going to play into the reopening into higher interest rate cycle, you want someone that has the lowest cost of funds, which is going to be OCBC and OCBC and DBS. I think for the first quarter, UOB was already up 20%. The rest, DBS were around, I think 9-10, and then OCBC 7. So these are some of the reasons which we preferred the other 2. Terence, I think you have the next. Pass it to you.
Yeah, okay, Paul, take over. Sorry. Yeah, okay, I'll just take the top voted question. Hi, Terence, would the increase in steel prices negatively impact the profit of BRC Asia? Hence, share price upside is limited. Yeah, so yes and no, CJ. In the short term, yes, because the accounting provision for onerous contracts means that the BRC Asia will need to account for this provision in their accounting statement. So profit will come down because they will need to account for the disparity between the selling price and the cost of getting the contracts. But in the longer term, no, because as BRC Asia fulfills these contracts, note that these contracts are actually typically hedged for about 6 to 12 months. So when they fulfill the contracts, and because they actually hedge the cost when they enter these contracts, they actually turn in a profit. So these onerous contracts will actually then reverse itself out in the later month, in the later financial periods, or when they fulfill these orders. So you actually get an earnings bump, even though you do the onerous contracts in the earlier years, but you get an earnings bump in the later years when you reverse these out and fulfill the contracts. Yeah, let me just go see if there's any more do you foresee more funding is required when Keppel Offshore and Marine and Sembcorp Marine merger is sealed? If yes, how would it be funded? Thanks. Yeah, so Michael, we see the funding requirement coming more from Sembcorp Marine. Keppel is unlikely to require any funding because they're actually the one divesting the asset. We do on your second question, how more funding, but we don't know yet how much funding is required because they haven't announced the deal yet. But if they announce, then Sam Marine will likely have to take on more funding, either through internal or external funding in order to do this, because they still, in their latest announcement, they still reported, they say that they're going to experience 3 years of consecutive losses. So we think the working capital requirements will continue to be high going forward. So and especially to take on Keppel's assets, they will definitely need funding. On your second question, how it would be funded, it can be likely external financing. We think, but we are not sure because they haven't announced the deal yet. But we think it could be another rights issue from from their shareholders. And they could also take on some green and sustainable loans, which can give them a better rate. And they've explored and also taken some of these green and sustainable loans as Sam Marine also start to pivot towards the green renewable energy space as well. Yeah. So let me know if I answer your question. I think that's all from me. I'll hand over the time back to the rest of my colleagues.
Okay, thanks. I'll move on to the next question. Is regarding the stock picks on Hong Kong market. There will be a replay. If you have to go to our YouTube channel, PhillipCapital, then I think you can get the replay there. They should be uploading it soon. Yeah. So it's the YouTube channel under PhillipCapital. Any views on semiconductor stocks like UMS and Franken in the next 4 to 6 months? I think they should still be fine. I think their customers are still doing well, especially for UMS and Applied Materials. But there is already a slowdown in their forward guidance, like for Applied Materials. So they're moving more to like mid-teens kind of revenue growth. So I think the first quarter, second quarter results will still be good. But post that, I think I'm just a bit wary because the cycle looks quite extended for semiconductors. Your update on Yoma strategy and what are the reasons for the current price momentum? I haven't really monitored. For Yoma, really nothing. Since I haven't really gone, not much of an update for me. Is the reason why we dropped coverage is just that of the whole political situation there. And we basically can't give investors an answer when and how strong can the recovery be in Myanmar. So it's more a macro reason why we dropped coverage, not so much a micro reason. I mean, they were owning some of the best businesses there, but because of this event, so that's why we kind of dropped coverage on Yoma. I guess the thing to monitor would be the placement of shares and funding from Ayala. So that would be the thing to watch, which I'm not sure. I haven't really checked on the latest update because they placed out some shares to Ayala, if I'm not mistaken, about 40+ cents. So they should be receiving the money soon. Yeah, I hope that helps. Hey, may I request for PowerPoint slides on SG Bank stocks? I logged in late and missed most of the. Yeah. If you want the slides, no problem. Just email us and we'll send you the PDF copy. You can email any one of us. Hi, Paul and team. What's your assessment? What's the risk of a recession in the next 12 months? I think it's unlikely. Slow down, definitely, yes. Yeah. I think it's almost imminent that there will be a slowdown because the Federal Reserve is just going to keep on raising rates. The thing to watch will be when the next Fed meeting in May. That's when they will, although the expectations are 50 basis points hike. So it's a bit tricky now because so if they go through the 50 basis point hike, so it will depend how the market reacts. Because I think inflation numbers will be really high and really problematic because all prices only started to move in March. So the inflation numbers coming out will be probably very atrocious for the next 1 to 2 months before it starts tapering down. So that could be the upside risk for banks, because maybe interest rates could even climb even further and cross the 3% in the 10-year yield. So that's one of the possible scenarios. But recession is unlikely, although the 10-year, 2-year yield curve has inverted. But you look at the other yield spreads, the 10-year, 3 months, and so forth, or the forward spreads, most of these haven't inverted. They are actually rising. So I think recession slowdown, yes, but recession we think is unlikely. And if we showed before in our previous chart, even if there is a recession, the stock market can still rally the next 12 months from the first point of inversion. Even if you do assume there's a inversion, I think if you look at our previous slides or last week, we showed you that. Thanks. Okay, I think the next is Natalie and a lot of banking stocks. Thanks.
Yeah, maybe I'll go first. Hold on, let me see. For OCBC, what is a good price to enter? As OCBC, our target price is $14.22. Currently, it's $12.60 now. So, I mean, I can't exactly say that when is a good price to enter, but I mean, there's definitely an upside to our target price. So I guess you can make your own assumptions from there. Okay, will there be an impact on the flattening yield curve on the margins of the bank? And if yes, do you see the downgrading of the bank's prices? So it's quite a few questions about the inversion of the yield curve. I think someone asked, so addressed to Paul, but I think I can answer it. What's the relevance of looking at the inverted yield curve, which has been a topic recently? So, okay, I'll explain what the inverted yield curve is. I think it's linked to the first question. So when the yield curve is inverted, it will mean that what happens is that the short term, the yields are higher than that of the long term. So what does this mean? Technically, it's sort of bad for the banks because banks borrow short term and lend long term. So they will not be able to make money if it's inverted. However, so the inversion means that there's no spread to earn for the banks. However, in reality, I would say it's not that bad for the banks because they borrow and lend at different points of the curve. So they tend to keep their average maturities of their loans and securities lower. So they tend to borrow and lend more towards the front or the short term of the yield curve. So to answer the first question, do you see, will there be an impact? There will definitely be an impact, but the rising interest rates will also help them to sort of earn more from their the float, which I think Paul mentioned earlier. And overall, I would say it's not that bad because most of the banks, they fund their balance sheet with low cost deposits. And the cost of this, which is what we place in the banks, it moves up very slowly. So they will be continuing to lend from their deposits. So I hope I answered both questions at the same time. I think that's all for the banks. I think I'll hand it over to Natalie. I think the rest of the questions are for her.
Thanks, Glenn. Okay, so the first question I see right now is, do you think retail recovery and growth has peaked? Also, DC REITs likely to be heavily impacted by utility costs. So for retail recovery, not exactly, because as mentioned, they are still trading about 10% below pre-pandemic levels. And in fact, for the growth, DPU growth in FY22, there's expected to be quite a significant recovery in DPU growth, DPU growth because of higher group sizes as well as the return of AHM sales. So and also car park income, of course. Yeah, so there is still some retail. There is some room for growth. Yeah, and for DC REITs, most of them most of the leases actually they pass through the cost of electricity, meaning to say there's a little margin that they will pass through the electricity on. That means they will secure the contracts and they will charge a slightly higher rate back to the tenants. So not that I know of. Let me try to see if there's any more questions. Okay, wait, I think that's all the question for me. Oh, sorry. Hi, any views on EC World REIT's refinancing? What is the likelihood of it resolving its problem? Will it be like Dasin REIT? Okay, so for EC World, when we look at Dasin is trying to refinance their IPO loans. So meaning that they have not actually done this before. They have not yet shown that they are able to refinance their loans. However, EC World this time around, the reason why it was flagged out that they are still in the process of refinancing is because they just released their annual report, and as part of the annual report, you actually need an auditor statement, or the numbers have to be audited, and because they were still in the midst of refinancing their loans, the auditors had to give a emphasis of matter kind of disclaimer to say that, they're still in the process of refinancing their loan, and if they don't, then that might lead to liquidity issues or solvency issues, and of course, in light of what is happening with Dasin, i.e. their inability to refinance their loan, and instead they have gotten 2 or 3 extensions. I think this is why the market is a little bit more nervous right now. But overall, I would say that if you look at the EC World's portfolio, they own warehouses and light industrial assets, or some e-commerce kind of assets, factory warehouses, then I would say we do not think that refinancing will be an issue for them. Yeah. And also, I think it also helps that they actually managed to refinance their loans once already. So this is already the second refinancing for them. Yeah. Okay. I'm just scrolling through. There's a question on Fraser's property. Sorry, we don't cover Fraser's property, so we don't really have much to comment on them. Yeah, I think that's all for me.
Yeah, I think I'll continue taking some of the questions in the queue. I think there will be a massive dilution in Sam Marine's share price again as a result of the merger, yes or no? Yeah, so we cannot speculate on the deal yet because they haven't announced whether they will reach a definitive agreement with Keppel O&M. Also note that they under the list of possible scenarios, there's also a chance that they don't reach a definitive agreement with Keppel O&M. So, but if they choose to go for the deal, we believe that it is a very high likelihood that they will have to raise money through equity financing. So that could lead to a dilution in Sam Marine's share float in the near term as a result of the merger. I think that's all from me. I'll hand over the time to the rest of my colleagues again.
Okay, let me just try to take up the some. Hi, will the big spending budget for military hardware, especially in the war zone areas, escalate the demand for iron ore? Yeah, thanks for the question. We don't think so, because steel is mainly buildings. You build one tank compared to building one building, you can see the amount of steel that will be used, and most of it, correct me if I'm wrong, Vivian, but I think maybe 50-60% of all the demand comes from China. So it's going to be still mainly linked, or iron ore demand, which is still demand, mainly linked to the property cycle or infrastructure spending in China. I don't think military can do much. I know it's bullets, how much steel can you put, right? Or airplanes. So I don't think it will be that significant. Yeah, but thanks for the question. Can you share a view on GoTo listed today in Indo Exchange, able to? Yeah, I think any stock on Indonesia should be able to invest in POEMs, but I think you need to ask we're not familiar in GoTo, apologies here, because it's Indonesia, so we're not familiar with that. But definitely can buy through POEMs because or all Indonesian stocks is available on Poems, in addition to multiple countries. Would you invite Malaysian stock analysts to present in organized stocks? Yeah, I think we could. I think we'll take that into account. Because of time, and Hong Kong is usually tends to be popular. So in the past, we used to have it all in one day, in the one-day physical event. But because right now it's webinar format, so that's why we didn't have Malaysia, because we also have US. But we will take that into account. Definitely do it when it's a physical setting. Last time when we had our physical events, we usually include Malaysia for almost every event. Yeah. But let us try to organize one so that we can get Malaysia in. Yeah. Thanks for the question. Is the current market still a buy, or should we start selling into rises? We still like the market, but doesn't mean you go in a straight line. So right now sentiment is there's less news flow and sentiment is a bit weak. So that's why you see this correction. But we are still fine with the market. Comments on Valuetronics, is the buyback complete? Okay, so just a bit of information. Some may not know Valuetronics. So Valuetronics is a contract manufacturer. It's like venture mini-me kind of, with factories in China and in Vietnam. What makes it unique is that almost half the market cap in cash. So the valuations are, I don't know, if you strip out the cash, maybe 2-3 times PE, or maybe 4 or at most. So of course the earnings has been weak because they shifted from China because of the trade war, and they have to move capacity to Vietnam. So recently they announced share buyback of, I think this is probably one of the largest you're going to see. They announced share buyback of 20% worth of the whole market cap. They announced 40 million buyback. Although the market cap is, I think, 200 over million. They just started. I think it's going to be like almost, they can keep buying for the next couple of months. Yeah, because they've put a war chest of I think their net cash is 100 million, if I'm not mistaken. So they're only using 20 million, 40 million, sorry, half of it, or roughly around 40% of it. So the good thing for Valuetronics is that you got a captive buyer there. Anytime you hit 50 cent or 52, 53, there's someone coming in to buy. Yeah, okay, yeah, sorry, it's a long answer. Wilma, any upside? I think we got the same question on Saturday, but our view, although we don't cover, our view for Wilma is going to be range bound, because some divisions are doing well, some divisions are not doing well. So doing well is plantations, but not doing well is the consumer packs, because they can't raise prices. Because they sell consumer oil, but in China, very sensitive to raise price. So they're getting squeezed the margins. And also their soybean crushing is not doing that well because of the weaker hog prices there. So we think unless their China arm, the listed company, starts to rally, the Yihai that she's listed on China A shares, but now that also the share price have been coming off. So we think most likely Wilma will just be range bound. Okay, this is a bank stock question. This is okay. I think the rest, I think some of you can you think. I'm not sure if you want to touch on sets, Terence, but yeah. Okay, I think I'll leave it to the rest.
Okay, I'll just take the one on the banks. Why are SG and US banks dropping even with the news of Fed raising rates? Is there an impact to the banks with treasuries rates rising? So I would say, as I mentioned earlier, I think quite a few people have been talking about the inverted yield curve, and I think it has been on everybody's mind. I think one point I want to bring up about the inverted yield curve is that a lot of people see it as a warning sign that investors will see a recession, like predicting a recession. So that's one of the reasons why the share price have been dropping, at least for the Singapore ones. The US ones, I mean, I can't really comment. I need to do a bit more research. So, but I also mentioned that why this inverted yield curve is not really a big, not that bad for the banks. Okay, I think that's all. I'll just hand it over to the rest of my colleagues. Thanks.
Yeah, I'll take the question on sets. Hi, can you share the outlook for sets? Thanks. So the outlook for sets for 2022 is positive. When we look at the first 2 months of the airport throughput arrivals at Changi Airport, the first 2 months is already half of what they did in 2021. So that is positive because it shows you that the growth recovery in 2022 is going at a much faster pace. And as Singapore relaxes their border restrictions with many of the different countries continue to relax, then we think that the visitor arrivals and the travel will continue to recover. But having said that, the numbers for the first 2 months of January 2022 is still about 10% of pre-COVID levels. So we are still a long way from recovery. So we think that the recovery will take some time, but we are comforted that for sets, they actually in 2021 they actually set a 5-year target of the kind of revenue and profit targets that they want to achieve, and that they typically don't do. In the past, they don't provide revenue guidance and the kind of targets that they did, but they set the targets in for 2026, and these targets bake in the travel recovery as well. So we think that's a positive for the group if they can achieve this. Yeah, I think I'll hand over the time to the rest of my colleagues.
Hi, I will take the question on Tassin's refinancing. Okay. Hi. Okay, so what's the latest on Tassin's refinancing? So for them, they've just towards the end of March, they announced that they will be. Oh, sorry, this is horrible. They announced that they are going to extend the loans until July 2022. Yeah, so that's the latest, and this extension is because the lenders are granting them some time to explore the non-binding MOU for the divestment of Shiqi and Xiaolan Mall. Yeah, so that's what's happening. They just last month also, they actually announced that they've entered into a non-binding MOU to sell these 2 malls to a buyout fund. Yeah. And one of the shareholders, or rather, New Harvest or Sino-Ocean, which is supposed to be their new incoming significant shareholder, is also part of this fund, this buyout fund. Yeah. So instead of trying to help them or secure or even lend them intercompany loans, they have joined a buyout fund to purchase Tassin's assets instead. But nothing is finalized; it's still in the early stages. It's still a non-binding MOU.
Yep, those already answered. Can you just say that it's already answered so you know? Yeah, is there a recording for Saturday strategy topics? Yes, there will be. Just go to. It should be on the YouTube, PhillipCapital. Yeah, we will just remind them to upload it ASAP since we get so many requests. What's the outlook for REX? Apologies that we don't really cover REX, so I'm not sure. Like what's their production profile and so forth. It's just a play on oil price, obviously. But again, apologies, I don't have any detailed understanding of it. Because when you cover oil companies, is very tricky. It's not just production. Then you have to understand the production sharing terms, how the higher revenue they share and cost they have to share with the authorities and so forth. So we did it's just too detailed for us to go into a deep dive into it. So don't have any answers for that. Do you think global agri will continue to go up? It should. I think since the most recent high was I think about 40 cents. Yeah, but apart from that, no real. Our preference would be actually coal. We think coal could have more room to grow. Once it's very hard to, when it comes to commodity, it's very tricky because it's so cyclical, right? So it's very easy to get it wrong. But at least for coal, we know there is a tailwind behind it. Because as we highlighted in our Saturday, even in our note, there's a new big buyer coming in to buy coal, to mop up all the coal, which is Europe. So Europe already stopped Russian coal. And because of number one, and number two, Europe has to buy coal because renewables is so volatile. It depends on it depends on the weather. So last year there wasn't enough rain, not enough sunlight, and then renewable energy was down. So they have to buy more coal because renewable is volatile or maybe not so reliable. And the third reason Europe has to buy more coal is because they want to reduce reliance on Russian gas, and you can't get LNG so fast. So coal could be something. And the fourth is, even the German says that they need to build up reserves for coal, which is unheard of because, especially in Germany, they just turn off like half their nuclear. The worst timing of all, they have 11% of energy from nuclear, and they probably have to turn off most of it by this year or maybe the next 1 to 2 years. I'm not sure how they time this, but anyway, this year they have to turn off at least half of their nuclear. So they'll be desperate for new sources, and that's why coal, we think, there's a new buyer for coal, which is Europe, especially from Germany. Yeah. How about, can you share your views on ThaiBev? So for this year, 22 will be a recovery year for ThaiBev. So from pre-pandemic, I'm using 31st December pre-pandemic, ThaiBev was about 89, 90 cents. So right now about 70. So we think it's still a recovery because in Thailand, it's obviously going to be a recovery because Thailand was shut. The entertainment was shut. They could not serve alcohol for like 1 month plus. And then in Vietnam was also shut. It was even worse. So you're going to get this, number one, recovery because last year was shut and then this year is open, right? So you get, and number two, you get a whole macro uplift because last year was so bad economic, especially for the lower incomes. So you get the economic improvement will drive the recovery for ThaiBev. But the thing for me, just a bit wary is that once you hit our target price and so forth, it just worried that the need to raise custom duties has been a bit long. So there's a bit worry that any time they could raise. So once it hit above 80 plus cents, then maybe you might have to take a bit more profit because you have to wait. Because the Thai authorities will raise custom duties on alcohol. It's just a matter of time. So it's just something that you just worry that you don't get caught into that as you play the recovery cycle. So that's the thing that just worries us for ThaiBev. Any update on Asia Force? Sorry, we don't follow. Yeah. Apologies. Yeah, don't really. For Yang Zhijiang, any timeline on their share split and how this affect STI? That's a good question. I'm not sure how they will work on the weighting, but I think they will probably adjust that. They will probably do my guess, because it's unfair, right? It's not reflective of the decline. So Yang Zhijiang, for those who don't know, is part of the STI. Although it's not large, I think it's probably 1% plus. My own guess is that after the thing, they will probably rebalancing and raise the weightage to others, because it's a bit unfair, if just because of a restructuring whereby Yang Zhijiang used to be financial, used to be shipping, so now the financial is no longer part of the list-co, so obviously the market cap will drop. But my bigger worry for Yang Zhijiang is that if the market cap has halved, so STI, the index providers might also say, why should Yang Zhijiang be part of the index? It's already so small. It's already kind of half. So there's also a risk that Yang Zhijiang may be taken out. But I don't think they should be penalized because it's not logical that they should be penalized. They might actually, like even CapitaLand, when they did the restructuring, the market cap obviously dropped a little bit, but we don't think they'll be penalized. I mean, that's a long answer, but we don't think they'll be penalized. Yeah. ST Engineering and SIA, I'm not sure, Terence, you want to?
Yeah, sure, Paul. We don't have any coverage on ST Engineering and SIA Engineering, but we probably just comment on some of the observations. For ST Engineering, they have already set a 5-year target of $11 billion in revenue. So typically their margins are quite stable. So if you can actually derive the profit but from the $11 billion revenue target in 2026. So the outlook continues to be positive for ST Engineering. They have almost 5 to 6 year high on their order book. I think it's about $18 billion now. So that's supporting them. One of their weaker business segments, the aerospace segment, is also seeing very strong quarter-on-quarter recovery according to the management. So I think the outlook on ST Engineering is positive. SIA Engineering also similar. They are starting to rehire workers in the industry because of the pickup in volume from one of their biggest customer, SIA. Yep, that's all for me.
Okay, so let me take the last question. Where do we get update on suspended counters like Pacific Radiance? So you go to the SGX, which even for us as analysts, that's where we go. You go to sgx.com. Then there are various tabs there. Then you just go for securities, which is the first tab. Then you just look for company announcements. Then from there, you will notice that Pacific Radiance will make announcements as the whole debt restructuring with the banks occur. So they will give periodic updates on how the debt restructuring with the banks is occurring. So that's how you get. And even for us, that's where we always look at the sgx.com website, look under company announcements. So that's where you get any update. I mean, not just Pacific Radiance, for any of the listed companies. Yeah, and if you want upcoming, the one that some may not know is like for some of these upcoming IPOs where you can't see the prospectus, they're not listed, is under Opera. There's another MAS Opera where you can get prospectus for upcoming companies. Because only when it's fully lodged will you get it on the SGX. Yeah. How can stocks such as Stock Best World ever get back to being tradable? I really don't know. Sorry, I need to go through to the announcement. Yeah, because I need to see what it depends on the SGX conditions. SGX will come up with conditions for you to fulfill. Then if you meet those conditions, then you can get traded. Yeah, but I'm not sure what's the conditions. Sorry, I don't have the details, so I can't really help. But that's usually the case. Yeah. Okay, I think with that note, I'd like to thank everyone for your time, and hope to see you again 11:15 next week, and hope everyone have a good week ahead. Yeah, thank you everybody. Thanks.